Deep Dive, Sable Offshore. Part 4, The Catalysts. This is not a traditional E&P underwriting. It is an event-driven unlock where the market is pricing two questions. 1, whether Sable can legally restart and sell oil, and 2, how much dilution or refinancing pain sits between today and stable cash flow. Even if oil sales eventually happen, Sable must survive the bridge period to get there. The infographic lays out SOC's restart as a single, compressed race against overlapping regulatory and financing clocks from 2015 to early 2026. It begins with the May 2015 Refugio spill and immediate shutdown, followed by nearly a decade of dormancy marked by repair work, integrity testing, and regulatory compliance efforts. In 2024, the asset changes hands under an Exxon seller financing structure, restarting the economic clock. By May 2025, SOC achieves a limited milestone with a partial restart to storage, but not full sales, leaving the core risk unresolved. The pressure intensifies in late 2025. In September, California's SB 237 adds state-level permitting friction. In November, SOC raises equity and amends its loan with punitive terms, 15% PIK interest and cash covenants, signaling acute liquidity stress. And in December, PHMSA issues an emergency permit while the Ninth Circuit declines to stay federal authority, clarifying the federal path but not eliminating state resistance. The two lower bands make the problem explicit. The regulatory track shows approvals, court actions, and state hearings stacking tightly into early 2026, while the financing track shows capital raises and debt terms hardening as time passes. Both converge on the same choke point, January to February 2026, state permit fights, and ultimately the March 1, 2026 restart and sales deadline, where failure to transition from storage to actual oil sales risks triggering reversion pressure and a binary outcome for the equity. Two political realities sit underneath the legal arguments. California's coastal regulators are structurally hostile to restart, and federal support can be time-bounded. Emergency authorities and special permits are powerful but not permanent renewal cycles, and administration priorities matter. The operational question isn't just can they win once, but whether they can sustain a federal path long enough to establish commercial incumbency. Catalyst 1. Pipeline approval. Fast path. The California blockage thesis weakened on January 2, 2026, when the Ninth Circuit denied an emergency stay requested by environmental groups, allowing Sable to proceed under the federal PHMSA interstate permit. Political delay risk remains, but the legal framework has shifted. The importance of the January 2, 2026 ruling is not that all risk disappeared, but that the center of gravity shifted. By denying the emergency stay, the Ninth Circuit allowed Sable to operate under PHMSA's federal interstate designation, rather than being frozen by California regulators while litigation plays out. That matters because it breaks the pattern of automatic injunctions that kept the pipelines idle for years. From here, opponents must win a full legal challenge to stop operations, rather than stopping the project by default. Political and procedural delay risk still exists, but the baseline has changed from blocked unless approved to allowed unless stopped, which materially improves the odds of oil reaching market and forces the issue onto a faster timeline. Catalyst 2. Exxon note resolution. Make or break. The March 31, 2027, or 90 days after first sales, maturity forces a decision. An extension or credible refinance would shift the story from default risk to funded execution. This is where the bear case is strongest. Exxon could demand punitive terms or heavy dilution. Capital markets may remain closed, forcing an expensive or controlled solution. This catalyst matters because it determines who ultimately controls the outcome. The extended maturity buys time, but it does not solve the problem. It simply defers it. Once oil sales begin, the clock accelerates because carrying 15% debt quickly becomes unsustainable. At that point, Sable must either refinance on acceptable terms or negotiate directly with Exxon. If capital markets are open, a refinance converts the company from a distressed situation into a funded operating business. If they are not, Exxon's leverage increases dramatically. Exxon can dictate terms, extract equity, or force a restructuring that preserves the asset but severely impairs shareholders. In other words, success on this catalyst cleanly unlocks value, while failure concentrates downside, making it the clearest make-or-break moment in the entire thesis. Catalyst 3. Offshore storage tanker route. Slower, cleaner jurisdiction. Federal approval for offshore storage and shuttle tankers would materially reduce California's ability to stall the project and improve financing predictability. This path is costly. Meaningful capex, additional financing, delayed first sales, and higher dilution risk, but it can still work if it reframes the project as federally permitted and financeable. This catalyst represents the fallback option if the pipeline path remains contested. By shifting exports offshore and using shuttle tankers, Sable would move the project almost entirely into federal waters, where California's regulatory reach is far weaker. That jurisdictional shift is important for lenders, because it replaces open-ended state interference with a clearer federal permitting regime. The trade-off is cost and time. Retrofitting platforms, securing vessels, and arranging offshore logistics require meaningful capital and likely additional equity, pushing first sales further out and increasing dilution. Even so, this route can still unlock value if it convinces financiers that the project is legally durable and operationally viable, transforming Sable from a politically stalled asset into a federally permitted cash flow story. This is not a traditional oil and gas investment. It's an event-driven situation where the market is really pricing. 2 questions. First, can Sable legally restart operations and sell oil? And second, even if it can, does it have enough financial runway to survive until cash flow stabilizes? Again, the first catalyst is pipeline approval, which is the fast path. In early January 2026, the Ninth Circuit denied an emergency stay sought by environmental groups. That decision weakened the idea that California can indefinitely block the pipeline and allowed Sable to proceed under a federal PHMSA permit. Political and procedural delays are still possible, but the legal backdrop has materially improved. The second catalyst is the Exxon note, and this one is make or break. The debt matures on March 31, 2027, or 90 days after first oil sales. Sable needs an extension or a credible refinancing. This is where the downside risk is concentrated. Exxon could demand punitive terms, and capital markets may not be available, which could result in heavy dilution or loss of control for shareholders. The third catalyst is the offshore storage and tanker route. This is a slower and more expensive alternative, but it shifts the project into cleaner federal jurisdiction and reduces California's ability to stall progress. The trade-offs are meaningful: capex, additional financing needs, delayed first sales, and higher dilution risk. Even so, this path can still work if it reframes the project as federally permitted and financeable. Taken together, the story is simple. The upside exists, but it depends entirely on clearing legal hurdles and surviving the financing bridge. Oil prices don't decide the outcome. Time, capital, and regulatory resolution do. Why this is an investable special situation. 3 factors make this compelling. 1. Built asset. The infrastructure exists and the oil is proven. The question is whether Sable is allowed to move and sell it. 2. Multiple monetization paths. Pipeline restart path. Offshore storage/tanker path. Slower and more capital intensive, but shifts authority to federal agencies and courts. 3. Option-like payoff. This is not a long-duration compounder. If the unlock occurs, the stock can re-rate sharply due to trapped cash flow and short interest. If it fails, the stock can go to zero due to leverage and hard deadlines in the Exxon purchase agreement and term loan. A simple way to frame upside is to translate restart into cash flow. If sustained sales reach about 40K BO/D, even modest netbacks can imply hundreds of millions of annual EBITDA. Apply a discounted multiple to reflect California risk, then subtract the senior secured debt stack. The equity outcome can still be multiples of today's market cap, but only if the capital structure survives the bridge and refinancing terms don't transfer most of the upside to creditors. The setup is simple. Secure limited approvals and enough financing to reach oil sales. If that happens, the stock works. If not, it doesn't. This is Avi. Like and subscribe. On to the next.